Imagine you have $10,000. You can put it into the stock market, or you can buy a luxury mechanical watch. Ask almost any financial advisor, and they will tell you to choose the stock market. But a fascinating economic shift is occurring. Certain elite timepieces are shutting their status as ordinary consumer goods and behaving like globally traded financial assets, which forces us to ask a very strange question. How exactly does a physical object that pays no dividends and generates no cash flow compete with the most powerful equity benchmark in the world? To answer that, we have to clear up a massive misconception. The luxury watch market is entirely fragmented, and treating it as a single investment category is a mathematical mistake. This line graph tracks the overall watch market over 5 years. The broad market lost roughly 3%. Compare that to the S&P 500, which surged to record territory. Yet specific elite references, like Patek Philippe, are generating massive gains, diverging from the broad market. To understand these astronomical returns, you have to ignore the average watch sitting in a retailer's window and isolate the specific references that defy standard economics. This diagram visualizes the entire watch market as a 3-tier system, which helps separate ordinary luxury from true alternative assets. At the top, you have consumer watches, bought purely for utility. Below that, established icons, highly recognized models that offer some liquidity but remain vulnerable to market shifts. For an investor, both of these tiers can be discarded. That leaves only the microscopic layer at the very bottom, the ultra-scarce collector pieces. These are the rare vintage references, the extremely limited production runs, and watches with immense historical significance. The serious wealth generation doesn't happen at the mall boutique. It happens exclusively in this highly illiquid micro-market, where the traditional rules of supply and demand stop working. Think about how a technology company operates. If demand for a new smartphone explodes, the manufacturer simply builds more factories and scales production instantly. A high-end watchmaker cannot do that. They cannot suddenly flood the market with their most desirable reference without destroying the exact scarcity and brand equity that makes the object valuable in the first place. This dynamic isn't unique to watches. You see the exact same strict physical limitation with classic guitars, rare art, and vintage Ferraris. This creates a bizarre economic paradox. The product becomes exponentially more valuable, precisely because the manufacturer refuses to, or physically cannot, produce enough of them. But fixed supply is only half the equation. You also need buyers. And globally, the billionaire class has been expanding, seeking ways to diversify their wealth outside of standard stock portfolios. At this level, the function of wealth shifts toward acquiring physical objects that remain inaccessible to the rest of the world. Decades ago, finding those rare objects was difficult and highly localized. Today, specialized auction houses and digital platforms have created a transparent, heavily tracked global price network. This network means a collector in Dubai can instantly compete for the same fixed supply reference as a buyer in London, Singapore, or New York. And that global demand can dramatically increase liquidity for the most desirable watches. It forces prices on the secondary market to detach from the original retail cost. Now, let's destroy the illusion of guaranteed returns. Luxury watches can crash, and they did. This chart shows the pandemic-era reality. A perfect storm of cheap money, crypto wealth, and social speculation inflated prices to unsustainable peaks. Then the environment shifted. Interest rates climbed, crypto corrected, and speculation cooled off. Secondary market prices plummeted from their highs. It is the ultimate economic lesson in alternative assets. Physical scarcity is meaningless without human demand. If demand evaporates, the financial premium vanishes. This is why comparing an elite mechanical watch to the S&P 500 is a misaligned comparison. They operate on entirely different economic mechanisms. The stock market is driven by corporate earnings, employment data, and productivity. The watch market is driven by a unique combination of physical utility, collectability, and pure human desire. The value of these objects reflect global wealth and status, rather than corporate performance. They act as a physical mirror for human psychology. So the next time you see a watch selling for $100,000, don't ask why it's so expensive. Ask how many people in the world want it and how few of them actually exist.